Hey everyone, and welcome. I am so thrilled you're tuning in today because we have a genuinely fascinating topic to unpack. We are looking at the macroeconomic roadmap for Nepal. Specifically, we're doing a deep dive into the Nepal Roster Bank's fiscal year 2026-27 monetary policy. But listen, we aren't just going to sit here and read off dry numbers. We're going to focus heavily on the real-world economic impact. Like, what does this actually mean for businesses, for job creation, for your everyday wallet, and just the overall trajectory of the nation's economy? Whether you're an economics student, maybe a professional gearing up for your Lok Seva exams, or honestly, just someone who wants to understand where the economy is heading, this explainer is built exactly for you. So let's just dive right in. Here is our quick roadmap for today. We'll start with the main economic targets, then look at banking and liquidity management, followed by the actual economic impact on productive sectors. After that, we'll explore the digital and green economy, and finally, we'll see how this whole policy synergizes with the national budget.
All right, Section 1, the main economic targets.
So here is the big one right out of the gate from Governor Dr. Bishwanath Podel, 7%. This is the government's highly aggressive economic growth target, and the central bank is actively stepping up to support it. I want you to think of this 7% as a heavy stone being dropped right into the middle of our economic pond. It is the catalyst for absolutely every single ripple we're going to discuss today. Because, to hit a 7% expansion, the economy needs fuel. It requires massive private sector investment, increased production, higher consumption, the whole shebang. But the central bank obviously knows you can't just print money and hand it out without causing some severe consequences, which brings us to the counterbalance. 5.5%. This is the inflation limit. And what's really interesting here is the immediate tension it creates with that gross target we just talked about. The central bank is attempting a very, very delicate tightrope walk here. On one hand, they need to pump enough credit into the system to hit that 7% growth. But on the other hand, they absolutely have to restrict the money supply just enough to keep inflation, which is literally just the rate at which your everyday goods get more expensive, below 5.5%. Because if they fail, well, all that economic growth just gets wiped out by the rising cost of living. So how on earth do they plan to walk this tightrope? The answer is a flexible monetary policy. Think of this as their balancing pole. Notice the core goal here. They want to boost activity and facilitate the private sector. Sure, but they're doing it with a strict safety net of price stability and banking security. Basically, it means the central bank is fully prepared to adjust the dials up or down as the year progresses, just to keep both the 7% growth and the 5.5% inflation targets in perfect harmony.
Moving right along to Section 2, banking and liquidity management.
Okay, so we know the targets, and we know they have this flexible strategy, but how is this actually executed on the ground? To manage the actual cash flowing through the economy, the central bank relies on everyday tools like open market operations and repo or reverse repo instruments. Essentially, this means buying and selling government bonds to control the cash flow. If the market is dry, they inject cash. If it's flooded, they mop it up. But the really crucial part for the overall economic impact is in those last 2 points: stronger non-performing loan management and risk-based supervision. Because as banks are encouraged to lend more to hit that 7% growth, the central bank is simultaneously tightening the leash on governance. They have to make sure that bad loans don't just pile up and threaten the stability of the entire financial system.
So the real make-or-break factor here is the interest rate strategy. The central bank is basically playing a giant game of seesaw. On one side, under this new flexible policy, they want to make credit accessible and lower the cost of investment for businesses. Cheaper loans mean more factories get built, more businesses expand. You get the idea. But on the other side of that seesaw, if interest rates drop too low, people are going to stop saving their money in banks. And obviously, if people don't save, banks don't have any money to lend. So maintaining this exact perfect balance between rewarding savers and encouraging borrowers, that is the absolute key to creating a sustainable economic impact.
Which brings us to Section 3, economic impact on productive sectors. Now, we are reaching the most vital part of today's explainer. We've talked about the high-level macro targets and the banking engine. Now, let's connect all of that to the real-world economy. Where exactly is all this money going? Well, the central bank isn't just blindly pushing credit out the door. They have drawn a very specific map, and X marks the spot on these priority productive sectors. The policy mandates that a massive chunk of credit expansion absolutely must flow into agriculture, SMEs, energy, tourism, IT, and manufacturing. This is a highly deliberate economic intervention. Instead of loans just going strictly into importing consumer goods, which, let's face it, drains foreign currency reserves, the policy actively forces capital into areas that actually build up the nation's internal economic capacity. Which naturally leads us to a pretty important question. Why these sectors? I mean, especially if you are studying for your NRB or Public Service Commission exams, understanding the why here is absolutely essential. Why prioritize an IT startup or a local agricultural processing plant over some massive commercial importer? Take a second and just think about the ripple effect.
Well, the answer is all about grassroots economic impact. By channeling funds into SMEs and agriculture, the central bank is targeting the very areas that employ the vast majority of the population. Think about it. When a small manufacturing unit gets a low-interest loan, they can go out and hire 5 more people. Those 5 people now have steady wages, which they spend right back in their local communities. That entire process restores private sector confidence from the bottom up, it massively boosts domestic production, and it directly feeds into that 7% growth target without relying on external factors. It's a total game changer.
All right, let's pivot to Section 4, Digital and Green Economy. The central bank isn't just looking at the traditional economy. They're actively shaping the future landscape, and it starts with a massive digital push. We're talking about the rapid expansion of digital payments, making QR codes ubiquitous everywhere you go, and heavy investment in fintech. But why does this matter economically? It's all about financial inclusion. Digital banking connects marginalized and rural communities directly to the formal economy. When a rural farmer can suddenly receive a payment instantly via QR code, that transaction enters the formal banking system. It creates a credit history, which then allows them to get loans in the future. And of course, with all this digital money zooming around, the strict enhancement of cybersecurity isn't just nice to have, it becomes an absolute necessity. And then we have green finance. This is a remarkable shift, honestly. The central bank is now formally directing the financial system to incentivize eco-friendly industries. We're talking preferential treatment or specific funding lines for renewable energy projects and sustainable development. The economic impact of this is huge, and it's twofold. First, it prepares the national economy for a global market that is increasingly demanding green compliance. And second, it funds energy independence, which helps reduce the massive economic drain of constantly importing fossil fuels. Finally, Section 5, Budget and Monetary Policy Synergy. This right here is the ultimate synergy. The government writes the budget and sets the vision, but the central bank is the one that actually manages the money supply. If these two don't row in the same direction, the economic boat just spins in circles. For the professionals and students watching, this breakdown is perhaps your single most important takeaway for understanding the national economic trajectory. You have what the government budget wants on one side and exactly how the central bank is making it happen on the other. The budget demands 7% growth. The monetary policy provides the necessary liquidity. The budget calls for agriculture modernization. The monetary policy mandates expanded agricultural credit. The budget wants an industrialized digital economy. The central bank eases access to targeted credit and promotes fintech. It is a completely locked-step approach, totally designed to maximize real-world economic impact. So if you had to distill this entire comprehensive policy down into one single defining mission statement, it's this: encouraging production, investment, and the private sector while maintaining price stability. Every single open market operation, every digital payment push, every SME loan directive, they are all laser-focused on this dual mandate. Fuel the growth, but protect the people's purchasing power. Which leaves us with this final, somewhat provocative thought. We've seen the blueprint today, we've seen the flexible tools, the targeted sectors, the synergy with the national budget. But as we all know, reality is often a lot messier than policy on paper. As global markets shift and unexpected domestic challenges pop up, the ultimate question really remains: can this policy actually successfully balance that 5.5% price stability limit with that highly aggressive 7% growth target? That is the exact space where economic theory meets the real world, and it is something we are all going to be watching very, very closely as this fiscal year unfolds. Thank you so much for joining me on this explainer today. Keep learning, keep questioning, and I will see you in the next one.